Hey, welcome back to Everything Money. We're glad you joined us again. Paul, this is one of our stocks that we've gone on a roller coaster with Alibaba. You were very much adamantly against Chinese companies in the past due to their regulations. You have seen in the past that numbers coming out of some of these companies are questionably legitimate, wouldn't you say?
Yeah, I don't know if I would say, well, speaking of legitimate, follow us on Instagram. Boom. I don't know if I'd say I was adamantly against China. I just always said, guys, you have to be careful because there have been very significant questions about Chinese data. Mm-hmm. I changed my mind. I don't like to clone. I'm not a believer in, this person has this portfolio, let me match it completely. Some people like doing that. Like our friend Manesh Prabrai likes doing that.
I like that, actually.
You like doing that, a lot of people do.
I have formulated a lot of the success in my life has been like pick someone I really like, and in my efforts to be like them or copy them.
Yeah, but you don't copy them 100%.
You're right, but I guess my point is in efforts to copy them, I end up becoming something greater than I probably was.
I don't disagree with that, but I don't mean if Charlie Munger has this portfolio, I'm going to mimic exactly his portfolio.
You're absolutely right.
I like that Charlie said, you know what, I trust the numbers coming out of here, I'm going to buy. That's what I trusted. I trusted his analysis of figuring out if the company was legit or not. And when he's buying the stock, he's done that work, and that's what I sat there and said. So if you showed me another Chinese company, the first thing in my head is, are these numbers legitimate?
Yeah, so Mo, I think we are not buying often. I mean, very few of our 900 episodes involve we're buying anything. In fact, most we're avoiding, which you should be as well as a value investor. But Paul, it's funny is we've made a lot of videos about Alibaba, and we're kind of. Do you feel like we're sticking our neck out when this thing could go south in that maybe we're wrong?
Listen, you're right, but being a value investor, our goal isn't to pick one stock and say we were right here. Our goal is to pick 30, 40, 50, over long periods of time. A great investor will be right 50 to 60% of the time. That's a great investor. Mm-hmm. That's not a lot, but people think that great investors are right all the time. I mean, go look at Warren Buffett's annual report. He talks about all the mistakes he makes, all the bad investments he's made.
Yeah.
Okay, my goal is to sit there and say, hey, listen, if these numbers are accurate on Alibaba, and because of Munger, I believe they are accurate, I think Alibaba is a stock that I want to own for 5 to 10 years, at least.
And this massive pullback has to do a lot with the irrational fear that we think that we're seeing right now.
So I brought up an article recently. Alibaba donates a third of its cash to Chinese incentives. Mo, do you know more about this? Apparently, they're giving away $15 billion to the Chinese government. Or no, $15.5 billion.
Yeah, so basically, the China government helps these tech companies get going when they're very small and gives them incentives to make themselves bigger. Alibaba has gotten to that point where they're bigger, and now the Chinese are saying, we need something back from you. So they're going to give them $15.5 billion over a 5-year period to go towards whatever their prosperity initiative is for their government. So that is kind of the first step towards maybe the government laying off of China or Alibaba a little bit. Other companies like Tencent, they're going to have to do this too. It's not just Alibaba.
And let's also think about what's the most successful company in China probably right now?
Alibaba.
Listen, as forget about the politics of China. The bottom line is they're becoming more and more capitalistic, right? And when you have this company that's doing extremely well in China and does very, very well all over the world, is the Chinese government really going to shoot? I mean, I don't know. Maybe they will. Yeah. If you have 100 of these, a few of them will end up being shot in the foot by their own government. But I look at Alibaba saying, this is a massively successful company that is competing with Amazon, that is doing great things in China. I think the Chinese government, I believe that even the ultimate socialists are still very capitalist for themselves, and I think it'll still work out.
And not even Alibaba. I mean, it's not like they're just China. Like, we've bought from Alibaba before. I mean, it's going to affect a lot of buyers. It's not just the Chinese.
You can buy from other countries through Alibaba.
Exactly.
So the other thing is, guys, I'm big on Alibaba. What percentage of my portfolio is it right now? It's about 1% of my portfolio now, and I'm hoping to get it to 3%. Mm-hmm. I still believe in diversification because I'm not going to always be right. I'm going to be wrong on a lot of things. I don't do the due diligence that, Warren Buffett doesn't believe in diversification if you're an astute investor. He believes in buying 6 to 8 stocks, know them intimately in and out, and own them forever. Not me.
And Seth, one more thing about the Chinese. So I was listening to Manesh Prabrai, who you and I both really like. He said that the Chinese are very much into innovate and then regulate. versus in Europe and here, it's kind of regulate and then innovate. So over there, maybe this is they innovated, now it's time to pull the reins back on them.
So if you've made it this far in the video, this is an extremely unusual case for us in that as value investors, we found a stock where the numbers are going up and the price is going down. If you're used to investing, whereas you see the stock ticker going up, and then you jump on board, not really knowing where the financial numbers are at, we'd like to introduce you to this channel and to our 8 pillars so you can see why we're in love with this company and why it's such a rare occurrence that we're saying we're buying this, Paul. So why don't you just pretend a new viewer who's watching this and has never seen you and your handsomeness, your cut abs and Mo's biceps. Why are you in love with Alibaba with the numbers? Let's start there.
Okay, so it's a very big company, 450 billion with a lot of growth. The 5-year PE is high, 27.66. We want lower than 22.5. Why is that? Because we sit here and look at it and say, okay, as earnings go up, you want to put more weight to the more recent years than the past years. Especially in a fast-growing company like this, I think it's okay based on the growth level to pay a higher premium. Companies that grow faster should be paid a higher premium because they're more likely to generate more income as time goes on. So I'm actually okay with this 27.66. 5-year return on invested capital, 10.5%. We want over 9%. So they're good about deploying their capital and making money off that capital they deploy. So I'm looking at it so far saying, I'm okay with this X, and I like this. 5-year return on invested capital. Okay, that's the first step.
Pillar number 3 is their revenue growth over the past 5 years.
I mean, look at this, 27 billion to 119 billion with massive growth. I mean, they're not 100 times bigger. What is that, 80 times bigger in the last 8-9 years? That's incredible.
And then we look at profit growth, which is our pillar number 4, Paul.
7.86 to 23. Now, I will say their profit hasn't grown as much as their revenue has grown, but their profit's also down in the last year. So I'm still check mark there. Shares outstanding, it is increasing, but not as much as a lot of growing companies here in the States. And this doesn't bother me as much. It's only a 5% increase over the last 5 years. Okay, I mean, again, they're trying to fund some growth. I don't know the reason for the shares increasing, but it doesn't concern me as much. It could be, remember, shares can increase because of people executing their own stock options and those coming out there. So there's a lot of reasons why shares can increase. This does not concern me. It's not a big jump like, ARK Investments. If you look at their top 20 portfolio, 215% increase in the number of shares outstanding. That's an insane number.
NEO just increased their shares yesterday, and you texted us about what it did to their market cap. Describe that. Well,
it's funny because somebody did tell me, somebody in our Patreon asked me for how do shares actually affect, share increases actually affect a stock price. Guys, if you own a stock, if there are 10 shares outstanding on a stock, and the stock makes $10 a year, the company makes $10 a year, you're getting $1 per share of that, correct? Mm-hmm. If they increase those shares by 50%, issue another 5 shares, now you're splitting that $10 amongst 15 shares. You're getting 67 cents per share versus the $1 per share before. That's how it directly affects. When people say, oh, it immediately gives a jump to the profit, to the market cap.
Doesn't always do that.
And by the way, even if it does, it's maybe for a quarter. Once the earnings release and the earnings, you always see earnings per share, earnings per share, earnings per share being reported, because what matters is what share of the profit are you getting as an investor. And the more shares they issue, the less share of the profit you are getting. It's very logical. It's very natural. It makes perfect sense.
Okay, Paul, so now let's look at pillar number 6. This is total long-term liabilities divided by 5-year free cash flow, and we want this number under 5. Can they pay off their debts?
Correct. So we go back to the original page, and the 5-year average free cash flow is 18.6 billion. Keep in mind, last year was 36 billion, right? So there's a big difference between last year and the 5 years. But what we want this to do, we multiply this by 5, and we want our total long-term liabilities to be under that number. Remember, folks, companies that have a lot of debt are more likely to go under. Companies with less debt are less likely to go under. It makes perfect sense. I picked 5 because a lot of value investors will say on the 1-year basis, look at 3 times. We're looking at the 5-year basis, so I increase the number for the exact same reason. So 18.6 times 5 is
I want you
90.
Keep going.
93 billion?
Yeah, 92.5. You're right.
Okay, so $93 billion. We want the long-term liabilities. Then we go to the balance sheet, and we go to long-term liabilities all the way here at the bottom, 36.6 billion. Guys, they can pay off They can pay off for 2 years of their average of the 5-year free cash flow, or 1 year. They just took last year's free cash flow. They could have paid off all their long-term debts. It's very difficult for companies like this to go under. And your job as an investor is to stay in the game as long as possible. And the less debt you have, the longer you're going to stay in the game.
If these numbers resonate with you, if you're kind of nerdy like me and you love this math, Paul, you're a huge math nerd. If this resonates with you, looking at the financials of a company, you can join our Patreon or everythingmoney.com. That puts you in the same spot. You get this software. It's yours to use on your portfolio today, and you get access to our Discord channel of over 5,000. My God, Paul, 5,000 people talking just like us. Tell them what they get, Paul.
So guys, you get all of these: mobile app, 8 pillars, 30 years of data, stock analyzer tool, daily content, all the way down, guys. Big thing is the exclusive daily content and the Discord community. This exclusive daily content will be only for people who subscribe to the app and software. And the Discord community of actually, Seth, 5,300 plus people who are talking. 87 cents a day, guys. Our good new intern, Nicole, got me how much did you pay for that hot chocolate, Nicole?
Oh, Nicole's got a microphone, babe. Say it again.
$4?
Probably $4.
So if she got this from me every day, would she ever come to me and say, Paul, you owe me $4? No, but instead she could have 5 subscriptions to our software. And all these other guys are way too expensive. $200 a month, $200 a month, $35. No checks. Come on.
I love how you said that, Paul.
Do you like that? I mean, it's true.
They're just way too expensive. All right, let's get after Alibaba's pillar number 7. This is the granddaddy of them all: free cash flow growth. Paul, you got to have that free cash. You know this.
You know, and the thing I like about free cash, guys, is earnings can be manipulated. Cash flow, it's harder to do that. You know, we talk about Enron. If you looked at the free cash flow statement, I was talking to Tim yesterday about Enron. The earnings showed $10 billion in earnings and $1 billion in free cash flow. You should have looked at that and said, not necessarily there's a scam going on here, but you should have said, I'm not comfortable with this company. And that's why you look at the free cash flow statement. It's harder to manipulate free cash flow. Is it still possible? Of course it is, but it's harder to do so. So I always go based off the free cash flow. So in the last 5 years, free cash flow went from 10 billion to 35.9, check mark there, with an average of 19.5. And so 19.5, which is different than our first number. I wonder why that is. Times 20 is $400 billion.
Now keep that up there real quick, because the actual market cap is $450 billion.
Now remember I said though, I'm okay because of how fast the company is growing to pay a premium to it. So even though this is an X, this is an example of where you ignore the fundamentals off the initial because you have to factor in growth. Growth is such an important part of value investing. If 2 companies are exactly the same, one's growing at 20% a year, one's growing at 5% a year, which one are you going to pay
Obviously
more for?
The growth, yeah.
Absolutely. And if you ignore that, you are being stupid, right? Now, what most people do, though, is they overpay for growth. That is what I'm trying to get you to do. We're going to do a stock analyzer tool after Mo does his charts, and we'll show you how you have to make sure you factor in growth properly for the future.
If you're looking to trade Alibaba at a faster pace, Mo tickles your fancy on a daily basis in that Bid-Ask Nation. Mo, are people trading this? I'm sure they are. What's going on over there?
So a lot of people are more of day trading this, but the important thing to look at here is just draw a straight line across, and you're kind of holding a support line. It has dipped a little bit below. The next support line way back here a couple of years ago was $150, so that's where we're going to stay. But this one to me, not a long-term play. Do this from a swing trading perspective. Try to grab these days where you can go up a couple dollars over a several day period. But more so than that, I would go and day trade this thing, because with the volatility, I mean, what's it? It's down 2% today. Yesterday it was up 4%. The day before it was 3 or 4%. So this is something that you can really capitalize from a 15-minute chart perspective. And if you want to learn how to do that, join the Bid-Ask Nation. Of course, it's easy.
Paul, this is a stock analyzer tool. This used to be an Excel spreadsheet that people were asking for. They're begging for this Excel.
Everything we've done is because people have said to us, how do I get that? And we're like, we'll just make it for
And that's
you.
how they sound. So so this is turned into the stock analyzer tool, which you get as a patron or a member of the Everything Money community. And so show us what you're doing back there with all those confusing numbers.
So guys, what I want to do is I use this tool for 2 reasons. One, to get a general idea of if this company is overpriced or not. I do it very initially. Then after I do more thorough research later on, I come back and put in more concrete numbers to decide what I'm looking at. So what it does is it gives you the last 1, 5, and 10 year data numbers here. So as you can tell, Alibaba's grown 40% last year, 44.5% over the last 5 years. I went in conservative and said low, middle, high assumptions, 15, 20, 25% growth. Share change, be conservative. Profit margin, I'm conservative. I went lower, lower, lower. PE, the current PE is 28. I went to 12, 15, 18. Same with the price of free cash flow. Then I do my returns. This is my, what return do I want to make out of my investment? Okay, 15, 12 and a half, and 10. When I hit the analyze button, I tend to focus on my middle number. I want to be lower than that middle number. That's my main focus here. So I hit the analyze button. Look at this, guys. The stock's currently at 168. I mean, we're close to the low numbers, but we're definitely below the mid and high. What this means, guys, is if you buy this stock in the middle area at 168 and the middle numbers are all accurate here, you're basically buying a $300 stock for 168. You're going to make almost 15% return on your money. That's the way I'm doing it. Now, this is all based on assumptions. And if the assumptions are correct, it works out. I can change the assumptions tomorrow, right now, actually. Let's say I sit there and say, hey, you know what? They're going to have better growth.
And people have been criticizing your low PE. I mean, if you put this up at a higher PE, even most of the Ys puts a little higher PE on some of these, Paul.
Well, I did put 15 for the middle tier. And people would say, oh, it's Alibaba. Don't forget, guys, as a company gets larger and larger, you cannot pay. It's harder to grow and grow, so you can't pay as big a premium. And my goal as a value investor is to be conservative in my assumptions. Now, you might sit there and say, well, 15 is too conservative. Maybe it is. But to me, for a company that's going to be $1 trillion company or more, 15 is a reasonable PE. So I'm going to stick with that.
People are also saying that this time is different. Can you show what a 20 PE would look like in that middle tier there?
In terms of value?
Yeah, I mean, because people are saying, Paul, you don't get it.
I think my PEs that I had were 15, 18, and 18 and a half, and 20.
Okay. Well, so let's see here.
See what it is.
I mean, look at this.
Screaming buy.
Yeah, screaming buy. So again, as long as you believe the numbers, so let's say, what do we have to be at? What does Alibaba have to grow to even
break even?
To even like say, Paul, you should buy it here. I mean, look at this. I even went down to 10% revenue growth over the next 7 years, and it's still in the green over here.
That's what I did yesterday. I crushed that and I crushed their profit, and it was still in the green.
So I feel okay. I'm going to keep in short term. This thing's going to go up.
Yes.
I mean, look at the last month of the stock.
And what kind of returns are you looking for there?
That was 12.5% in the middle tier.
Oh, okay. That's what I pretty
I mean, look at the last
10, 11, 12.
This thing was at, just in June, 3 months ago, it was at 230. Then fell all the way to 157, 155. I mean, it's just all over the board. I look at it saying, I feel like I'm buying a good company. I have puts on this company. I've bought shares. I'm very comfortable with it. I'm comfortable with it being 3% of my portfolio. I'm going to keep rolling with it.
That is our take on Alibaba. Paul, it's a really rare occurrence, and if you hopefully you learned something in this video about a company where the trend is upward and the stock is down. It's a great time to buy, and so that's why we're buying it. So all right, that's our take. Join the Everything Money community at everythingmoney.com, and we'll see you in the next video. Fondle the thumbs up on the way out. We love you.